right? But Michael, I noticed when Jim just asked you about EBIT, that was your answer just now. So how do you want investors to value you then? What should we be looking at, or I should say the investment community be looking at for the metrics that tell us you are succeeding in your goal, given the long-term contracts, given the lack of free cash flow, given the enormous debt you're taking on, but obviously the success you're having in signing up new customers all the time?
Yeah, look, I think that the market is going to get very, very comfortable valuing us based on the fact that we have been able to grow in such a controlled way with contracts that will drive such significant margins. It's the magic of this company is that it's growing. You know, our revenue growth in our last earnings call was to take the company from $5 billion to in excess of $12 billion by the end of this year. That ramp comes with enormous opportunity to drive margins as we continue to grow, but we need to have an opportunity to scale, and scaling is expensive.
No, I agree with that, although I think we have to pay people at home know that they need to know that you are losing a lot of money. But there's one thing that you have done very right that was regarded as a risk factor, again, focusing on those, which is that you told me and others that this depreciation worry, that the buying of these NVIDIA chips after, say, 5 years, these things would not only not be worthless, but they'd be worth a lot. This is something only two people told me, you and Jensen Huang, the CEO of NVIDIA. How did you know, and how wealthy is your company based on all that you took down when you started?
Yeah, look, we continue to see new use cases come into our ecosystem and make use of past generations of hardware. This is something that we have seen since we founded the company. We see wonderful new creative companies coming into existence that are going to be able to consume those GPUs that will be enormously accretive to our company. But we also see within these large labs, these large buyers, they go ahead and they use that infrastructure for the most bleeding edge work cases in the initial instance. And then as it begins to age and new generations come along, we have seen them take that infrastructure and use it for inference, use it for other use cases that they have to accomplish in order to drive their business. Those signals have been out there since AI began. And we have been scaling our business with the intention of holding that equity slow, holding those GPUs, because we believe that they are going to continue to be incredibly valuable when they come off these long contracts that pay back all of the debt we're taking on. And it's important to understand is the debt that we have is leaning into offtake contracts with the largest companies in the world, right? We run the GPUs, we will pay for the infrastructure, we will pay for the debt, we will pay for the interest, and we will make a profit. And then the GPUs become available for us to sell again. And we just think it's a wonderful business and it will drive margins into the future.